I have to admit, it was the most volatile holiday period in the stock market and the credit markets that I can remember. All kinds of crazy things happened just when market participation was thinnest. The S&P 500 had plunged day after day before Christmas, and the chart of daily closes going back 2 years had formed a mountain on the left with an ominous vertical cliff on the right. So, over the weekend before Christmas, I published an article titled, "Nothing Goes to Hell in a Straight Line, Not Even Stocks." The headline is somewhat tongue-in-cheek, but it's one of the most important concepts governing the markets these days. Every major drop will be followed by intense buying as investors, speculators, algos, specialized hedge funds, and so on jump into the fray for short-term trading profits or because they think the bottom is in. In the article, I indicated that we would get a substantial rally starting in early January. Then on Christmas Eve, stocks plunged, booking their sharpest Christmas Eve loss in history, blowing my theory out of the water that nothing goes to hell in a straight line. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you're listening to the Wolf Street Report. It's December 6, 2019. But on the first trading day after Christmas, stocks skyrocketed. The Dow jumped nearly 5%, as did the S&P 500, and the Nasdaq exploded with buying pressure, jumping nearly 6%. The buying was widespread. All of the equity sector surged indiscriminately, with some of the most beaten-down stocks surging the most. And the beaten-down price of crude oil soared over 9%. This was followed by more days of ups and downs, and then the sharp rally on Friday, January 4th. Friday marked the last day of the two-week holiday period during which there are fewer market participants, meaning that there is little liquidity in the market when relatively minor changes in buying or selling pressure can have an outsized impact on prices, as we saw on Christmas Eve or on December 26. In my article of the weekend before Christmas, I didn't expect stocks would plunge on Christmas Eve, simply because they'd never plunged like this on Christmas Eve. And I'd never seen a 5% rally of the S&P 500 during the holiday week. These are crazy moves, and those crazy moves won't be the last crazy moves. This rally will eventually be followed by a sell-off that will make people's ears ring, and that will make President Trump edgy again, and he'll blame the Fed or who knows what. This sort of thing leads to a nerve-wracking pattern of lower lows and lower highs. If you look at this with a perspective of decades, it makes sense. We had a monstrous decade-long rally with huge stock price gains year after year. At the same time, the U.S. economy grew at miserably low rates that are now called the new normal. And to obtain these miserably low new normal growth rates, companies have taken on record amounts of debt, as has the U.S. government. The amounts of risks investors have taken on are enormous. This was central bank policy. The Fed has tried very hard to get investors to take on these risks by making lower-risk investments pointless. And high-priced stocks are among the riskiest investments out there. Now investors get to relearn that risk actually, and surprisingly for many, goes both ways, big returns and big losses. And there is a slew of reasons why this house of cards that is the stock market after a decade of rallying is coming unglued. Here are just a few of them. 1. Companies are walking back their revenue and earnings guidance at a rapid clip. This includes most notably Apple, and analysts are scrambling to lower their earnings forecasts to bring them closer in line with coming reality. 2. The impact on year-over-year earnings growth from the tax cut was a one-time affair. 3. Some of the economies where corporate America is very active, such as China, are facing a host of problems. 4. Share prices are immensely inflated still, even after the sell-off. 5. The Fed has hiked interest rates. For the longest time, this was completely brushed off by investors in the riskier end of the corporate credit markets, such as junk bonds or leveraged loans. But this started changing in October, and now the actual cost of borrowing for these companies is surging in line with the risk premium that investors are suddenly demanding. This is triggering higher financing expenses for our over-indebted corporate America, and as investors are getting more skittish with risky corporate debt, plenty of companies will not be able to refinance their maturing debts over the next few years, and some may even be unable to finance their cash flow negative operations. And when this happens, the company defaults on its debt. The resolution of this process, often in bankruptcy court, wipes out stockholders. 6. For now, the economy is doing well, and employment and hiring are strong. However, peak growth was in the second and third quarter last year. That growth could not be maintained. Instead, growth has started to taper off toward the new normal, as we call it, and then after the tapering of growth, eventually there will be a recession. We don't know when this recession will arrive, but we know that with every day that passes, we're getting a day closer. The goods-based sector will slow down first. It is already tapering from the boom period that lasted through the summer, and this growth will continue to taper towards some sort of low-level normal growth, and then growth will slow further. The goods-based sector went into recession in 2015 and 2016 that included mass layoffs in some segments. An overall recession was avoided because the services-based economy was strong enough, and services are the biggest part of the U.S. economy. Financial services now account for about 20% of GDP, and healthcare accounts for about 17% of GDP. Between the two, 37% of GDP. How did we get this far, that these two sectors dominate the U.S. economy? I don't know either, but for a recession to occur, financial services and the goods-based sector will have to enter recession jointly. That didn't happen in 2015 and 2016. Only the goods-based sector went into recession, but it dragged GDP growth down to just 1.6% for the year 2016, the lowest since the financial crisis. And that's coming our way. The first signs are cropping up. We're seeing a mix of tapering of growth in some data, sharp slowdowns of growth in other data, and even the horrible term negative growth in other data. This includes the year-over-year plunge in orders for heavy trucks in November and December. These are the trucks that move a big part of the goods-based economy across the U.S. They're the first indicator. In today's everything bubble, nearly all asset classes are overpriced, and traditional diversification is impossible because nearly all asset classes soared together and are now losing the footing together. And it makes this a very precarious era for investors. Investors have gotten spoiled. They're still counting on huge annual returns of the type they experienced over the past few years when the Fed was carrying the water. They think that making 3% a year is stupid. Only a moron would go for that. And so they lose 10% or 20% because they're taking the same risks they took in prior years. And now they're learning that risk means not only making big returns, but also taking big losses. It goes both ways. A whole generation of new investors came into this game learning from the everything bubble that taking risks means making lots of money, not losing lots of money. So gradually, these investors will be put through the ringer. For them, it will be a very ugly learning experience. Plenty of investors remember the last few bubbles. They remember when the S&P 500 index sold off 50%, which happened twice already over the past 20 years, and the Nasdaq plunged 78%. But they might now consider that those sell-offs were something that happened in the distant past and won't ever happen again, that the Fed or whatever won't let them happen again. Yet we're due for another one. But even in the past, none of this happened overnight. It happened in bigger and smaller sell-offs, followed by short seller crushing rallies, followed by more sell-offs. Some of the cycles were short, lasting only a few hours, such as sharp intraday rallies that blow up before the day is over, and some of the rallies lasted weeks or even months. Each such rally spread hope that the bottom was in, and investors started buying again, and just then the next sell-off started, and those investors, if they didn't get out in time, were taken out the back and shot. In the U.S. markets in the past, this process went on for several years. In Japan, this process has lasted for 3 decades, and the Nikkei is still down 50% from the peak in 1989. Chinese stocks are down 60% from their peak in 2007. German stock prices are down nearly 20% from their peak 19 years ago. Italian stocks are down 60% over the same time period. French stocks 18% and Spanish stocks 33%. Those markets had huge amounts of central bank support, including QE and negative interest rate policy. After an enormous bubble, such as experienced by Japan until 1989, or by China until 2007, or by the Euro countries in hopes for the Euro boom until 2000, or by the United States during the everything bubble, it can take a very long time for prices to find a bottom and then to recover. This can take far longer than the normal time frame investors have in mind, but it just doesn't go there in a straight line. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you listened to the Wolf Street Report.